Welcome to This Explainer. Today, we're going to demystify an absolute beast of a financial machine, the $80 trillion global equity market. Now, 80 trillion, that's a number so huge it honestly just kind of feels abstract, right? So to really wrap our heads around how this massive engine actually works, I want you to imagine the world economy. But not as a bunch of boring charts and graphs. Instead, picture it as a giant, infinite neighborhood.
Think about that for just a second. What if, in this giant neighborhood, instead of just owning your own house, you had the chance to literally own a piece of everyone else's business? You know, the bakery down the street, the tech startup across town, or even a massive automaker on the totally opposite side of the world. Well, that is the core magic of the stock market. It's an entire system designed to turn everyday people just like you and me into corporate partners, literally transforming small ideas into global empires.
Okay, let's dive into Section 1, the basics of ownership. Let's see how starting small turns into those global empires.
Let's look at a hypothetical entrepreneur. We'll call her Sarah. Sarah issues common stock to fund her brand new solar-powered coffee company. Let's call it Sun Coffee. Now, for her new partners, the folks who buy that common stock, this means three key things. First up, the upside. They get a share of the profits through discretionary dividends. Second is the safety net, which is limited liability. That just means their personal assets are totally protected if, say, the company faces a catastrophic lawsuit. But third, we've got the risk, residual claim status. If things go south and bankruptcy hits, common stockholders are literally the absolute last in line to recover their capital. They're stuck waiting behind the employees, the government, and the bondholders.
Now, contrast those regular partners with a totally different class of owner. Let's say Sarah wants to raise more cash, but she doesn't want to dilute her voting control over how Sun Coffee is run. Well, she issues preferred stock. These investors, they act a lot more like VIP guests. They give up their right to actually vote on company decisions, but in exchange, they get a fixed, periodic dividend that acts almost like a bond. And here's the kicker. If Sarah misses a payment to these VIPs, it accumulates. She absolutely has to pay them back in full before her regular common stock partners ever see a single cent.
Moving right along to Section 2, the big debut.
Fast forward a few years and Sun Coffee is absolutely crushing it. They're ready for the major leagues, so Sarah hires an investment bank to be her guide through the primary market timeline. First, they file a registration with the Securities and Exchange Commission, the SEC. Then, they send out what's called a red herring prospectus to potential buyers. It's named for the stark red warning label printed right on it, basically saying, hey, this info is still preliminary. After the SEC does their evaluation and gives the green light, the official prospectus drops, and then the incredibly exciting day arrives when shares are finally offered to the public. Crucially, this primary market phase is the one and only time Sarah's company actually receives cash directly from the sale of the stock.
Which brings us to Section 3, the global trading bazaar.
Once that IPO wraps up, the dynamic shifts entirely. Sun Coffee's shares enter what we call the secondary market. Here, investors are trading directly with one another, and Sarah's company, they no longer see a dime of that cash when shares change hands. This massive, bustling trading bazaar really happens in two main arenas. On one side, you have the New York Stock Exchange, or NYSE. It's a grand, physical hybrid market where these designated market makers literally stand at physical trading posts to make sure buying and selling happens in an orderly way. On the flip side, we've got the NASDAQ. This is a completely electronic, highly competitive dealer network. No physical floor, just a massive web of computers connecting buyers and sellers at lightning speed.
But you know, what happens when things go seriously wrong in this high-speed digital bazaar? Say, a sudden 20% market plunge. Well, if the overall market drops that far, it triggers the ultimate safety mechanism, a circuit breaker.
I really want to emphasize the drama of this hard-coded rule because it's fascinating. If the market drops by 7% or even 13%, trading is simply halted for 15 minutes. It just lets everyone catch their breath, process the incoming news, and calm down. But if that decline hits a staggering 20%, boom, the entire market is forcibly closed for the remainder of the trading day. It's an emergency brake, plain and simple, designed to protect investors and stop a total freefall panic.
Now, to avoid that kind of panic and just keep track of the overall health of our global neighborhood, we use indexes. Just think of them as giant scoreboards. First, we have the Dow Jones, which watches, well, actually it watches exactly 30 older, massive corporate giants. Then we have the Wilshire 5000, which is basically the broadest index out there, covering virtually every single US stock. But the one everyone watches most closely is the S&P 500. And because it's value-weighted, the absolutely largest companies,
I'm talking giants like Apple or Tesla. They heavily influence the direction of this entire scoreboard. If those guys move, the whole market feels it.
So you might be wondering, how fast does information actually move in this bazaar to change those scoreboards? Well, that brings us to market efficiency. This measures the speed at which stock prices reflect unexpected news. Strong form efficiency actually suggests that markets are so incredibly fast and so sophisticated that even private insider information is already baked right into a stock's price. Because information is basically the main currency of the market, regulators like the SEC step in to act as the neighborhood sheriffs. They're there to ensure full and fair disclosure, making sure everyone is playing by the exact same rules.
All right, let's look at Section 4, Crossing the Atlantic.
As Sarah looks to expand Sun Coffee internationally, she discovers a starkly different financial culture. The massive $55 trillion U.S. market relies heavily on market-based stock sales, and it is absolutely obsessed with explosive tech growth. But Europe's market? It's much smaller, sitting around $25 trillion, and it's heavily fragmented across different countries. Plus, European companies rely way more on traditional bank loans for financing. When they actually do issue stock, investors over there expect high dividend payouts. That market is heavily dominated by older industrial companies rather than flashy tech startups.
And this cultural divide creates a very distinct valuation gap. We measure this with the price to earnings, or PE ratio. In the US, investors will gladly pay $20 to $25 for every single dollar of corporate earnings. But in Europe, that ratio drops significantly, down to just 12 to 16. Basically, European stocks trade at a serious discount, and that's mostly due to lower growth expectations and a much smaller technology sector compared to the US.
But Europe has a massive advantage in one really specific area: sustainable investing. Europe is hands down the global leader in requiring and rewarding strong ESG factors. That's environmental, social, and governance. Because European investors heavily prioritize these ESG ratings when deciding what to buy, Sarah's eco-friendly, solar-powered mission for Sun Coffee is actually going to make her company an incredibly attractive investment across the Atlantic, far more so than some traditional, carbon-heavy industrial firm.
So, stepping back, who actually owns all these billions and trillions of dollars? It isn't just shadowy billionaires or faceless corporations. Nope. The single largest slice of the pie, at exactly 41.5%, is everyday households. Whether they're holding stocks directly or participating indirectly through things like mutual funds and pension plans, ordinary people are the actual primary owners of this vast economic engine.
Which brings us to a final thought. We've traced the entire journey today, from a single entrepreneur's idea to a publicly traded powerhouse, navigating global bazaars, SEC sheriffs, and making the jump across the Atlantic. This massive financial machine exists solely to turn ideas into shared ownership. So the question is, knowing exactly how it all works, are you ready to claim your corner of the global neighborhood? Thank you so much for joining me for this explainer, and keep exploring the incredible mechanics of our financial world.